What are central bankers trying to do? Last week, we had 4 central banks reading from the same script. But is anyone convinced that they know what the story is? I'll tell you who isn't: gold. With 4 interest rate announcements, 4 lots of inflation slowing, and 4 lots of attempts at reassurance, we invite you to take a look with us at what central banks really have up their sleeves and what this means for gold. Welcome to GoldCore TV, helping you make sense of the precious metals market so you can make better investment decisions. I'm Jan Scoyles, and I'm just a girl standing in front of some charts asking them what the fudge is going on. This whole year has been about central bankers busting the balls off inflation. We've had hawkish statement after hawkish statement. We've had hike after hike, and we are now beginning to see official inflation numbers signal that times are changing. But this isn't good enough for Jerome Powell and his band of elves. They apparently want more. They want more hikes. They want more tightening. In the US, they don't want to let up until US inflation hits its target of 2%. And it's a similar story for the likes of Christine Lagarde of the ECB, Andrew Bailey of the Bank of England, not to mention the Bank of Japan, who seem to be coming around to Powell's way of thinking. So what am I talking about? Last week, Powell and the FOMC voted to raise the federal funds rate to 4.25%. This is an additional rate hike, even though the Fed's very own updated projections showed slower growth and higher unemployment. But somehow they equated this to yet more inflation and a higher Fed funds rate. The statement made clear that more tightening in 2023 is going to be necessary to bring inflation down to the 2% target. And compared to the September meeting, they now expect there to be even more tightening than they did a few meetings ago. So we're now looking at further rate hikes to the total tune of 0.75% next year versus the previously projected 0.25%. So to be clear, the Fed now projects higher inflation and a higher Fed funds rate than it did in September, but raised the Fed funds rate by only 0.5% this month versus the 0.75% back in September. The whole thing seems counterintuitive. And all this is so that they can hit the US inflation target of 2%. A target, by the way, that is so unbelievably arbitrary. It's the equivalent to when you asked your parents why you couldn't do something, and they'd reply with, "Because I said so." So a central banker is now admitting that they don't know what they're doing. What do you think they're doing? Tell us in the comments below. Are they only now realizing that inflation isn't something that can be resolved in a few months? Are they only now realizing that things are actually outside of their control? Say a pandemic, say a war, maybe even just the weather. It wasn't that long ago when we were being told that inflation was merely an illusion or transitory, as one wise banker described it. And then they had an epiphany and realized, no, inflation really was deep set in the global economy. And now they do actually seem to be making an impact there, but actually they're not sure they are, so they will just stay hawkish for now. It's like they now want us to think that they're clueless with all this flip-flopping. Why the desire to create an illusion? Is this the tale of what happens when the era of cheap money ends? Are the central bankers realizing that they encouraged us for too long to take greater risks, so now they want to discourage us by appearing like they don't know what they're doing? Are they trying to make us more cautious? Here's what Powell said following the announcement. My view and my colleagues' view is that this will take some time. It's good to see progress, but let's just understand we have a long way to get back to price stability. Of course, Powell might be right to be cautious. Inflation might seemingly be on the way down, but the truth of the matter is that things still remain out of his control. The US job market might not cool down enough to reduce wage pressures. No one really knows how things will play out with Russia next year, and the reopening of China may well create an inflationary wave, not to mention that there is so much cash swirling around the economy that the true impact of its presence is yet to be fully realised. To be fair to the Bank of England governor, Andrew Bailey, he sort of broke ranks with the ECB and Fed when he stated, "We have possibly seen this week the first glimmer that figures are not only starting to come down, but it was a little bit below where we thought it would be. And that's very good news, but there's a long way to go." This is following a decision by the Bank of England to raise interest rates by 0.5% to a 14-year high of 3.5%, the 9th consecutive rise. The Monetary Policy Committee, like the FOMC, is still anxious of a recession, but it is more positive in that it said it expects the downturn to be shallower and inflation was lower than previous forecasts. Of course, a decline in inflation and a hike in rates doesn't mean all is well in the world. Absolutely not. A year's worth of monetary policy and a few rate hikes does not for a solution make. We are at the end of an enormous monetary experiment. Extraordinary, totally unprecedented. Interest rates are not going to save the day. So whilst the interest rate hikes might have muted gold's performance in a year of 40-year highs, this does not mean the yellow metal has not been doing its job. And what of gold? It's the piggy in the middle in history's longest ever tug of war. On one side of the rope, you have negative financial factors such as increasing interest rates. And then at the other end, you have all the safe haven reasons for holding gold, such as the pandemic and inflation and a recession. The opportunity cost of holding gold is interest rates because you don't earn anything on your gold in a vault or under your mattress. The opportunity cost has arguably grown in the last year as central banks increased their rates in the fight against inflation. And yet, here we are after multiple hikes across central banks, and actually, gold's okay. It's holding its own. At the time of recording, it's sitting well above its September low of 1600 and way above its average of 1350 for the last decade. In short, gold is holding its own and it is seeing through the rhetoric of the FOMC and all the other members of the central banking tribe. And whilst interest rates and a spiking dollar might have caused a bit of headwind for gold this year, the yellow metal knows that on the other side of Fed hikes and dollar strength, there is a strong risk of recession. An interview with perma-optimist Nouriel Roubini provided a much-needed reminder to gold naysayers about why we need to insure our portfolios with the yellow metal for the coming years ahead. Did I ever worry about a war among great powers? No way. There was the détente in the 1970s and Nixon went to China. The risk of nuclear war went to zero. Did I worry about climate change? Never even heard about climate change. Did I worry about global pandemics? The last one had been 1918. Did I worry about AI destroying jobs? Did I worry about deglobalization, trade wars? No way. Did I worry about populist parties of extreme right or left coming to power? We didn't have the same polarization we have today. Did I worry about major severe recession or Great Depression? Of course not. In the 1970s, we had stagflation, but then we had the Great Moderation. Did I worry about financial crises? I never even heard about financial crises. And to bring you some real Christmas cheer, just take a look at this chart from Incrementum. There's a lot of numbers on here, but just focus on the bottom line. For every major currency, gold is up. On average, it is up 5.2%. This is after a year of rapid rate hikes from the central banks and a strong dollar. Gold isn't going anywhere. It is so dismissive of central bank rhetoric, flip-flopping or bizarre strategy that it's just sticking with its own plan. And who knows this better than anyone else? Central banks. Check out our video on central bank gold purchases and who has been stocking up on this yellow metal to prepare themselves for the year ahead.